Now, over the past year or so, I've been buying a ton of different stocks and ETFs and stacking up shares in my long-term portfolio, trying to get this portfolio to the most amount of total yearly dividend income and, of course, the most monthly dividend income that I can do so in a safe manner. Now, I've, of course, been buying tons of shares over the last year of Realty Income, things like jepi, and, of course, my favorite SCHD. But I've also, as of recently in the last year, gotten the itch, if you will, to buy into some of these ultra high yielding ETFs, which have helped me substantially raise my total yearly and total monthly dividend income a lot faster than other traditional methods. Now in this video specifically, we're going to talk about a newer ETF that I've been buying like crazy over the last year. I actually added it up and I spent around $14,000, $15,000 in total so far. We're going to talk about the fact that this ETF yields around 16%, offers a nice positive total return, and a strategy that I'm very, very bullish on. So if you want to learn about this and go through this ETF with me, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So I'm sure maybe some of you guys guessed which ETF I'm talking about, which ETF I purchased around $14,000 to $15,000 of so far throughout this year, and that I still am buying more shares of as of right now. I'm talking about the Simplified Volatility Premium Income ETF, or SVOL, or ticker symbol SVOL. Now I came across this ETF a while back and I made a few videos about it. I talked about the fact that although the strategy seems interesting, I think it's a little bit too risky for my liking, and for that reason I only bought a few shares of it here and there. But the fact that it has a targeted distribution, that it pays for the most part every single month, and the fact that it trades mostly sideways or a tiny bit down to the right definitely had my attention, so I continued to buy some more shares here and there. But to back up for a second to understand exactly how this ETF works, what this ETF even is, it says the Simplified Volatility Premium ETF, or SVOL, seeks to provide investment results before fees and expenses that correspond to approximately 1/5 to 3/10 the inverse of the performance of the Volatility Index, or the VIX, short-term futures index, while also seeking to mitigate extreme volatility. It then says the fund's short VIX positions provide investors an optimized exposure for monetizing the premium in the VIX futures market. But on top of that, this is very important, a modest option overlay budget is then deployed into VIX call options to help protect against adverse moves in the VIX, which we are definitely going to talk about here in a second. So what does this all mean if you're lost here? Let me explain it to you very simply. For the most part, as you can see over time, the volatility index, or the VIX, trades pretty much flat or even down over long time periods. And this is due to the fact that at least over the last year or so, market volatility has been pretty low. So during times where market volatility is low, if SVOL shorts the volatility index, they have the ability to generate a ton of income by doing so. Now they also implement a modest call option overlay, once again because adverse moves can and will happen in the markets. And as you can see, back in August 5th, we saw the volatility index spike like crazy, which you might be wondering, how in the world did SVOL survive? So this is kind of cool. On the Simplify ETF's website, they actually broke down exactly what happened. They said volatility strikes back. 2 weeks ago, volatility struck back after an exceptional long period of market calm, during which the S&P 500 went 356 sessions without a drop of 2% or more, the longest streak since 2007. Table 1 provides specific details of the historic VIX move from July 31st, 2024 to August 9th of this year. This spike in volatility was fueled by a combination of factors, including earnings reports, things like job data, ongoing recession fears, and the sell-off in the Japanese market, driven by the unwinding of the yen carry trade. Now you can see right here on August 5th intraday high, the VIX close was 65.73. This was 181% change on the daily and also 302% VIX percentage cumulative change. So it says, how is SVOL different from other short VIX products? Investors pay a premium for protection, driving up the demand for hedging via VIX future contracts. This results in an upward sloping futures curve known as contango, a condition presented approximately 85% of the time. SVOL capitalizes by shorting the VIX futures at various points along the curve, not just at the front of the curve, because each point of the curve has a distinct roll yield and volatility profile. The flexibility is paramount to SVOL's success versus products just shorting the front end of the curve. Additionally, SVOL typically shorts between 20 and 30% of its portfolio across VIX futures term structure, greatly limiting the downside risk to other products with more exposure. And there's lots of short VIX products out there, really. Finally, SVOL allocates 2 to 4% of its portfolio annually to mitigate VIX spikes, utilizing strategies such as purchasing call options on the VIX or implementing equity puts or put spreads for added protection. So it really wasn't until the most recent volatility spike that I was sort of sold on purchasing a lot more SVOL, because I actually got to see it firsthand in front of my eyes while I had a ton of shares of it in my portfolio, how this ETF actually performed during the massive big spike. Now don't get me wrong, it was still a pretty rough day for SVOL. I think it was maybe down 4, 5, 6, 8% on that day. But again, because this ETF strategy, it still was very impressive on how it held up. Now digging a little bit deeper into SVOL, on the max time frame, the ETF is down around 13.6%. Year to date though, it's only down around 2.3%. On the 1 year, it's down around 3 or 4%. So I've talked a lot about the fact that I do not like buying into ETFs that trade down and to the right. And although SVOL basically has done that on the max time frame, I started buying it not that long ago. So since I started buying it, this ETF, to be fair, has traded mostly sideways. Now this is still something that I'm concerned about, and over the next year or so, if it does continue to trade down to the right, that's going to be something I'm gonna have to figure out on if or if not I still want to hold on to it. But I do think that if volatility in the markets stays somewhat calm, which I think it will be, I think if anything we're going to have less volatility in the next year or so from here, I think that products that short the VIX are going to do quite well over the next year or so. Not to mention, even if SVOL does trade down to the right just by a tad or even trade sideways, the 30-cent distribution more or less that we've seen since inception for the most part averages out to around 16% yield if it keeps paying this consistently. Now this is given investors on a 3.34 year timeline since SVOL started trading around a 10%, 11% average annual total return if dividends are reinvested, and around an 8 or 9% if they aren't. So I get it, there's other products in the market, there's other ETFs that might offer a lot more yield, a lot more upside, or maybe both. But in my opinion, SVOL offers the protection because of the strategy, but also a ton of income in the form of distributions for the most part consistently, which has been amazing, especially in the context for a dividend or income focused investor trying to get their income to a certain point on a monthly basis. Now, I still believe that this ETF should be more of an alternative ETF in an overall long-term portfolio. Just because of the strategy, it's sort of risky. It's only been trading for a little while. And honestly, I just wouldn't want to have too much of my portfolio wrapped up in a strategy like this. But like I shared with you guys, as of right now, I think I'm holding around $14,000 or $15,000 of this one. And I'm probably going to keep growing the position till it's near $20,000 or so, and probably cap it at that. Which, at least for me in my portfolio, that's still a relatively small portion of my overall portfolio, maybe just a few percentages of my entire portfolio combined. But to be fair, because of the strategy and because how much yield SVOL offers, this ETF as of right now is paying me more or less $200 per month, which is pretty insane considering I only have around $14,000 invested into it. So now that we went through and I shared with you my more or less 16% yielding new favorite ETF, at least as far as ETFs that yield that much, I lastly, most importantly, want to hear from you guys down below. Is SVOL or the Simplified Volatility Premium Income ETF an ETF that you personally have in your portfolio as of right now? Let me know yes or no, and why not in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.